Welcome to this session on CPO valuations held by Homes England's local government capacity centre. I'm Claire Giles, I'm the head of compulsory purchase for Homes England, and I will be leading this session and the Q&A at the end. And we have two excellent speakers who are both friends of Homes England to give you some case studies and real life examples as well. As I said, this is a very specific subject today in terms of valuations relating to CPO. Following previous CPO sessions that we've had, that was requested, that it's something that people would like to hear about, which is why we're covering the topic today. So just a quick a plug, as it were, for the local government capacity centre. Hopefully you're all booked in for lots of talks in this winter programme. We do 2 programmes a year on a range of topics that we think that you want to hear about. And we're also offering various other things now, as well as the actual capacity centre training. But essentially what we're here to do is to try and support resource and capability in local government and partners to increase sort of capacity and skills to drive basically what we want to be doing in terms of regeneration and housing delivery, creating high quality homes and thriving places. And if we can do that, well, we can help you to do that, then that we all win. Next slide, please. As I was saying, there are now other offerings from the capacity centre. So as well as the 2 learning programmes per year, the winter and the summer programme, we now have on gov.uk a housing information hub, where there's a range of professional resources that you can go to and have a look. There are also some new fact sheets about building new homes that you might find useful. And there is also a capacity analysis tool where local authorities can assess the capacity in your own organisations and maybe see where the gaps may lie. I would also at this point just put a little plug in that Homes England and DLUC, we're working together to actually put together some CPO specific information. DLUC are looking at a register of orders that will be made, because if you look for them at the moment, it can be quite difficult to actually pin down the actual information around orders. So there will be a library that DLUC will be hosting on that, and I will also be looking to get some best practice information and templates live up in the next year or so to help you with your CPO ambitions. Next slide, please. So a quick overview of what's going to happen. So I'm welcoming and introducing now, obviously, Claire Giles from Homes England. I'll then introduce our speakers, Selina and Becky. We'll have an hour's presentation, but it will be very much, case study based, quite interactive between the 2 speakers as well. 20 minutes for Q&A at the end, and then I'll do a final wrap up before we all leave to go and have our lunches, no doubt. Next slide, please. So the 2 speakers that we have today are very good friends of Homes England. We have Selina Wakeham, who's a partner at Carter Jonas, based in Birmingham. I actually used to work with Selina at the District Valuer Service as well, so an old hand in terms of CPO, and it's her day job every day, so she's a true expert. And we also have Becky Farr from Birmingham City Council, very well versed in CPO, been very successful in CPO herself at Birmingham City Council, which I'm sure she's going to talk to you all about today. So I'm going to pass over to the 2 speakers. I'm going to go off camera and look at questions, and then I will return later for the Q&A. So ladies, over to you.
Hello, good morning. My name's Selina Wakeham, which Claire's already made you aware of. I am a chartered surveyor based across the Midlands within Carter Jonas, but my hub is Birmingham. I specialise in compulsory purchase, compensation and land assembly, acquisitions of a compulsory nature, and prior to any CPO or other methods of compulsory acquisition that, from a consenting point of view, that comes in place. So, okay, that's me. So next slide, please. So today, the remit that Claire's given us is to really focus on valuation and cost, and how that kind of ties in with compulsory purchase and valuing land and property as a result of a compulsory acquisition. So everything's governed by the Compensation Code. What is that? That is a cluster of statute and case law that essentially builds in what's known as the principle of equivalence, which is is putting a claimant landowner in the same position that they were prior to the acquisition, and that's a fine in case law and under statute. That focuses on a financial equivalence, but complications and complexities around that can lead to that being quite difficult to assess at times. But essentially, that is the underlying principle of valuing when we've acquired land for under the threat of compulsion or by compulsion. And you'll probably have heard it, the compensation code. It's not in accordance with the compensation code, or it is in accordance with the compensation code, and that essentially is what we mean by that. And I've listed some sort of key statutes. I haven't listed all the case law because we'd be here all day. So, but essentially they are the key statutes that govern the code, and there is more, and there are some up-to-date ones that are reforming the compensation code and continue to, but they're the main principal ones that we work to as a practitioner when valuing for under the threat of compulsion or by with compulsion. So next slide, please. So I've put together typical heads of claim that fall with a compulsory acquisition. The first one being land taken. So that's valuing what we have taken for a particular scheme. And that falls under what's known as Rule 2 under Section 5 of the Land Compensation Act 1961. And that is essentially market value. It runs alongside the principle of market value, and that is at a set valuation date, which I'll go into in further on in this presentation. Then there's injurious affection, and that is any loss in value as a result of the loss in value to the retained land. So if we've taken part of some land or property, that is looking at the retained land and the impact on that land as a result of the scheme, or and I'll talk about that later on. Then there's severance, which is essentially gets mixed up with injurious affection quite a lot, and generally it should be treated separately, and that is the loss in value as a result of the land being severed, split in two. There are other examples. Mainly happens on farmland. You've got a slice that's gone straight through a field, and it's looking at that impact on having for example, two severed parts due to having, for example, a road scheme going through. And that's found under Section 7 of the Compulsory Purchase Act 1973, the definition and how to assess for that. Then there's disturbance, which in practice does lead to quite a lot of debate and negotiation, and that is any losses separate to the market value for the land taken. That is a direct consequence of the scheme. For example, a house, you're buying the house, and that person's got to leave that house. So it's, for example, removal costs and potential fixtures and fittings in the new property as a result of acquiring that house. And I'll talk about that in a bit more detail later on. Then there's statutory loss payments, which are set up to deal with the impact of having your land acquired compulsorily, and really dealing with the buggeration factor of having to leave or and have your land taken by compulsion. Then there's the professional costs. So every claimant is entitled to have professional advice, and that is looked at quite closely. There is a lot of debate in the industry on how reasonable that is. I act for claimants and I act on the acquiring authority side. The Compulsory Purchase Association does a lot around this, and it's looking at what's reasonable alongside the acquisition, but the claimant essentially is entitled to have professional representation, and under the Compulsory Purchase Code those costs are paid. And then there's the legal costs, which have a separate statutory right as part of the acquisition, and they tend to be the conveyancing costs that are linked to the acquisition, and can also lead to legal advice where you've got some complex issues, and that does occur quite a lot, as you can imagine. Okay, and basically that are the typical, those are the typical heads of claim, and essentially that they are looking at, as previously discussed, the principle of equivalence. Next slide, please. So I'm going to pass you on to Becky, because we're kind of tag teaming this. I work with Becky quite a lot because I act for Birmingham City Council, and we thought we'd mix it up so I wouldn't be talking to you constantly. So over to you, Becky.
Thanks, Selina. Hi everyone, I'm Becky Farr. I'm Development Planning Manager at Birmingham City Council. The city has quite a tradition of using our CPO powers. I've particularly been involved in the CPO and regeneration at Perry Bar to deliver things ahead of the Commonwealth Games, and I'm leading on 2 significant CPOs in our city centre as well at the moment. So I've got experience of quite large CPOs, and I appreciate that, you know, working at different scales means that different authorities will have sort of slightly different requirements, but that's sort of one of the things I wanted to pick up on really today was, although, as Claire said, this is about process more than money, it's about money more than process, today's conversation, but I'm going to start actually by talking about practical elements around governance, because that's where, if we're getting it right with our project management, our responsibility as public sector bodies, and also in line with the guidance, we sort of really need to start. Budget's obviously not just about compensation, but if you understand the financial position at the outset, you can think about the impact of your decisions on acquisitions and compensation. So if we move on to the next slide, please, Lucy. So CPO is always a matter of last resort, but it's also a tool that can incentivise and provide, at least to a degree, some certainty. And therefore, whatever land assembly is required for a project, we should be planning and preparing in advance to use our CPO powers. And we should think about the cost implications of doing so. The cost of acquiring land may not always be fully known at the beginning, and the points Selina made around the range of heads of claim that you might need to consider are really important. But budget's always going to be one of those things that we're considering. So what does this process look like? Well, as I say, for different local authorities, it will look slightly different, but there are some clear fundamentals to consider. Some of the points I'm going to make may not seem on the face of it to relate to budget or indeed compensation, but all of the decisions you make have potential ramifications that affect your compensation payments. So you'll probably start by seeking authority in principle for your CPO. This enables you to get started on the work that you'll need in place to ensure that you've got a robust case, and that will include detail that will inform your budget. But before you get to the point of having that fully worked up case you'll need in order to make your order, this is usually a cabinet approval, but obviously different authorities will have different delegations, and you'll need to consider the processes and procedures in your particular authority. Getting councillors on board is key. Cabinet members probably more interested in things like the financial risk, reputational risk, and overall budget, whereas your local councillors, particularly in the affected areas, are going to be interested in process, in timing, and how their constituents may be compensated. So depending on how comfortable your councillors are with the process, that can be quite a time-consuming exercise. When you seek that authority is also important, because going early is great. It can maximise the opportunity for negotiations, really engage with the affected parties. But actually, if you go too early with insufficient information, you can leave people hanging and feeling very uncertain. So it's really important that your CPO process is at the heart of your overall programme. It shouldn't be tagged on as an afterthought. There's a lot of dependencies between other elements of your programme. So it might be things like when the planning consent is received, it might be the business cases that you need to get in place for funding, or other statutory procedures or approvals. So what do you need to consider in preparing this report? Well, obviously, you've got to define your boundary. normally you go for your maximum extent of the land that you think could possibly be required, because it's easier to take land out than put it in. But you do need to be careful, because going too wide can add extra work. You get additional objections and potentially additional costs and compensatory items. So you need to be careful about what your boundary is and the degree of certainty you have around that. You might also be able to think at that point, or not, about things like rights of light, crane oversailing, and other impacts on adjoining landowners that may also necessitate compensation. You'll obviously have to think about what powers you intend to use. You'll need to think about your justification for CPO. And at this stage, it's likely that certain elements of your case are, you'll be able to talk about what your intention is, but not have the, and maybe explain how you're going to get to that justification, because you won't be fully there yet. And that's likely to be the case around budget, including land acquisitions and compensation. You'll obviously need to do things like your human rights, equalities appraisal, etc. You'll need to think about who's funding your CPO. Is it the local authority funding it themselves? Is it a grant through Combined Authority or Homes England, for example, or maybe a third-party developer? And what's covered in that? Is it just the land, or does it include fees? So at this early stage, you probably consider your land acquisition costs, the cost of buying the land and the compensation associated with that. And then you'll have the land procedural costs, which is your administration of that process, I suppose, your agents, your staff time, things like that. As I said, this might be quite limited at this stage in terms of what you can be definitive about. If you've got a third party involved as well, a developer, for example, you'll also need to think about the indemnifying of those costs at this stage. You'll also need to know in very general terms how the scheme will be delivered, scheme viability, etc. But that we could have a whole other session on that. So we'll sort of assume for the purposes of today that one's covered. In seeking authority in principle, you would also usually delegate authority to make acquisitions in the defined area. You would need to consider whether you can do that straight away, whether the budget's in place to do that, how you'll handle compensation under the shadow of CPO, and whether that's, as I say, does that happen straight away or does it kick in further through the process? You'll also need to include recommendations to procure the appropriate supporting work, such as your land referencing, the agents who are going to prepare your property cost estimate, which I'll come on to in more detail on the next slide, and to conduct your negotiations and any legal support, for example. And then you can get those commissions underway and start to develop a degree of certainty around your budget associated with acquisition and compensation. The authority to make comes later, once you've carried out those meaningful negotiations, and when, in simple terms, the remaining barrier to delivery is the ownership of the land. The authority to make you seek from, again, your executive, and it usually sits alongside a business case or provides detail of how costs will be met. And that the political process and the governance process at this stage is really important to having more certainty as you move through the process around budgets. So if we move on to the next slide, I'll talk a little more on that. So the property cost estimate is probably the most important tool you have as a local authority in managing your CPO and your budget. Usually you'd commission this once you've got your authority in principle, although you're quite likely to have had some kind of draft or indicative PCE in advance. In its simplest form, what a PCE is a fancy spreadsheet that lists everyone that you want to acquire, every interest you want to acquire, and all of the costs associated with doing so, and it gives you a bottom line budget. So you'd include the market value, the items that Selina presented on her previous slide, where you tot up your different elements of compensation, things like SDLT, legal fees, and you'd include a contingency element there as well. And the first iteration is likely to be a desktop exercise, but as you get more information, it's important that there's a regular update. So as your land referencing is updated, as you have any early engagement, you need to reflect that information about new interests, new considerations in terms of your approach to valuation and compensation, and the direction of negotiations. It's worth noting that the PCE is, if you amend your PCE, you are amending your project budget, and you need to think about how that works within your current governance. So just to refer to a project I'm working on at the moment, the PCE is revised formally by the Site Assembly Working Group on a 6-monthly basis, and assuming that the variance is within a pre-agreed percentage, that gets reported to the project board, and that becomes the new budget for land assembly. If the variation is outside of that pre-agreed percentage, we would have to get board approval rather than just reporting it to them. So you can set up your governance around how you do that. And the reason that's really important is it means that the whole project has a clear understanding of and an agreement on the level at which offers should be made and the scope for negotiation there. You might on some projects take an approach that allows flexibility for agents to seek to make offers or do deals within a certain percentage of the PCE figure. You may choose to control it differently. There are different approaches which will suit different projects. And as the local authority whose CPO powers are being utilised, you need to be satisfied that the negotiations are genuinely meaningful, and therefore that the PCE does reflect a reasonable approach to valuation and compensation. And in my experience, this has been particularly important where the CPO is funded through a third party whose first driver might be to keep costs to a minimum, or where it's important to have robust evidence to support compensation claims. So if you need to claim grant funding from a combined authority or someone like that, and on that point, it is really important to agree what the evidence is that's required to support values. So if I'm asking Selina to prepare a report and setting out a justification for a particular value, I need to be clear that the funding party, for example, is going to be content that there's sufficient information included there. So I'll hand back to Selina now to cover some of the other points on the heads of claim, and I think I'll pop back up later to cover a couple of other things. Thank you.
It's worth noting on the back of your point, Becky, that as a practitioner providing this PCE advice to acquiring authorities, you need to be specific on those assumptions, and they're really important. And having that contingency in place and looking at that quite closely, because we do get criticised for putting a contingency in these days. I like to keep them in because you never know, particularly if negotiations are not sort of further down the line, a contingency helps to cover an element of risk. So it's just worth noting that.
And I think someone popped something in the chat about including extinguishments as well, and I think
that's disturbance. So yeah,
particularly as you get more information, you reflect your approach to your disturbance compensation and any other elements by updating your PCE on a regular basis.
And I can't stress that enough. A 6-month basis, particularly when you're at the start of the scheme, is so crucial. Because things change daily through the negotiation process, and particularly when you've got a big scheme. And we saw that, didn't we, Becky, when we were doing the Perry Bar CPO. So yeah, okay, back to me. So Section 5 Land Compensation Act, Rule 2. So this is obviously market value, which I discussed in my previous slide. So next slide, please. So compensation for the value for land taken. I'm going to give you a bit more of an overview on those heads of claim now, just to give you a bit of a feel of how those items are assessed. So as previously said, that is Rule 2, Section 5 of the Land Compensation Act. And it's the value of land shall subject as hereafter provided be taken to be the amount which the land, if sold in the open market by a willing seller, might be expected to realise. And that essentially is runs alongside the definition of market value. And it is you value it as at the valuation date, which I'll go into on my next slide. But essentially, it's about gathering as much evidence as possible to support that market value. And it's as if I was doing a full RICS, Royal Institute of Chartered Surveyors, valuation in accordance with the definition found within that the Red Book is market value. And that, for example, I've got one at the minute where I'm actually valuing some industrial land, which, would you believe, is quite difficult in the centre of Birmingham, because the market at the time when I'm needing to value it is 2020, which we all know what happened in 2020. COVID hit. The market was quite stagnant from March to September. And we've got a valuation date right smack bang in the middle of that. So, and it does require some interpretation of evidence, making some key assumptions, generally done on the basis of comparable. For that one, it's a comparable basis, and looking at alternative, if it's got any future development, etc. We have to take that into account. But it's about making a valid assessment as at the valuation date. Next slide, please. So the valuation date can be a mixture. If we've served notice to treat and notice of entry, depending on the scheme, and the acquiring authority and the motivations behind moving forwards, it depends on which one's chosen. A notice to treat and notice of entry, if we've done that, then it would be the earliest of the date of entry or the date when the assessment is made. So usually when a notice to treat is served, we work to the date of entry, and from my experience, I've always done that. If a general vesting declaration is served, it's the earliest of the vesting date or the date when the assessment is made, if agreed at tribunal. It tends to be the vesting date. An example of why a general vesting declaration would be used, if we're in most of these projects, it's all hands on deck, let's get moving. We want the contractors on the ground, so it tends to be an easier option because the land vests immediately with the acquiring authority. With a notice to treat, you've got 3 years to serve a notice of entry, and it's sometimes beneficial if you've got potential to move design around, and that's when you've got 3 years to serve a date of entry, and also if your program is not quite as advanced, and however you want the certainty of acquiring the land, then a notice to treat is probably more appropriate. And they determine the date in which the valuation is made. So essentially, it's about making your assessment as close or as on that date. And like I've said before, it can be quite difficult at times, particularly for the one I've got in on this industrial site. The valuation date smack bang in the middle of a sort of market sort of freeze. However, we've got to make the claimant putting them back in this equivalent financial position as well. So it's about making an experienced judgment, essentially based on the evidence that you've got available. And that one has proven quite difficult, but we are there, and we've just agreed the values, so that I feel a lot better about that one now. But essentially it's about, and it does form part of the negotiation as well, making sure you've got the appropriate evidence to support that. So fees, so as I've discussed, so next slide, because this is sort of an interim slide, isn't it? Yeah. So the acquiring authority does have an obligation to pay reasonable fees for having the claimant represented appropriately. It does help, in my opinion, to keep costs down as well, because especially if you're dealing with an appropriate, experienced surveyor on the other side.
Yeah, for sure. Do you want me to add a bit more on this one?
Yes,
Selena?
definitely. Yeah.
So I think the background here is that in an ideal situation, if someone is appropriately represented, you might even get to the point where you never need a CPO. That's the dream scenario, isn't it?
Yeah.
And that's why covering claimants' representative fees is really important. It's also important because the guidance requires us to do that and to consider how we might do that. But the real bottom line is that this is something that can really enable you to save money, actually, and to reach a proper professionally advised answer and outcome that is as far as possible a win-win all round. So I'll just pick up on another project I'm working on currently, where we've taken an approach that's quite structured and procedural to ensuring that we are covering representatives' fees appropriately. So the particular CPO is funded by a third-party developer, but of course the legal powers sit with the council. There's a jointly appointed agent to conduct negotiations, and it's a CPO that affects somewhere around 70 parties. I couldn't quite remember actually when I was thinking this through this morning, all of whom in theory could reasonably make a claim at some point for representatives' fees. The third party developer has quite limited CPO exposure, and as such they raise a lot of often very legitimate but a lot of questions about every potential cost that's incurred. So we've taken a view of taking a very consistent and managed approach to this. So first thing we did was developed a decision-making matrix so that any fee request is considered against that matrix. We haven't actually declined to pay any fees as yet, but if we were to do so, we'd have an agreed basis on which we could make that decision. And we know that everything that we are agreeing to pay has gone properly through the project's governance. Then we prepare a fee request form, which sets out the value. It sets out what will be delivered for that fee. So that's something that's agreed between the claimant's agent and our agent, so that we know, therefore, that it is reasonable and subject to appropriate evidence. It's something that can be compensated. And it sets out a timetable for such work. It also, going back to the PCE, it notes whether the fee is covered in what we've allowed within the PCE, or whether we may need to amend the PCE as a result of the ask. And then the payment is agreed by the council, the developer, and the claimant's agent then have the certainty that they'll be paid for the work, and the affected parties don't incur those costs at risk. But most importantly, to some degree in terms of programme and process, it means they're well advised and that you get genuine negotiation that's properly managed, and any issues that are likely to arise can be addressed early. So I think this is something that's come up in recent decisions around the importance of negotiations and proper negotiations being held. This is a really important element for local authorities to bear in mind, and to think about what your process is for making payments early in the process before you are actually acquiring land.
And old school negotiations, from a claimant's perspective, it would be normal practice to pay the agent at the end of the claim, but that has moved on a lot since, particularly because they just can't manage the cash flows like that as a business anyway, and we have to understand that. But also it drives progress, it really does. If we are showing willing to support the payment of agents' fees, it does support the negotiation. We show them the money to do that. And having dealt with a number in my time of unrepresented claimants, the costs always increase because of the level of negotiation and managing.
We've had some interesting ones at Perry Bar, didn't we, Selena, with people who people who had an element of knowledge and wanted to try and address the issues themselves, but CPO is specialised, and there are certain you can get so far, but actually there are certain things that using someone who has the right skill set will really make a difference to the outcome.
Indeed, it really does. And also it kind of makes it a professional environment to negotiate as well, because it does get personal with representatives, and you do have to be understandably empathetic, because it is a stressful process. But having clear representation that kind of deals with that appropriately, and I would definitely always recommend that claimants do get their own representation when dealing with the negotiations. But not always, doesn't always happen, and not always the case, but it's definitely a way, in my opinion, looking at the content of this presentation today, it does help with costs. It really does. Next slide, please. So injurious affection, next slide. Thank you. Compensation for injurious affection. So injurious affection is quite a controversial subject. I was in the DV's office with Claire for some years, 16 altogether, working mainly on road schemes, and had a lot of cases that involved injurious affection, particularly because where there's offline linear projects impacting on properties. And what is it? So it occurs when only part of your property is taken, and it's the value of the part you retain that decreases. And it's looking at that in detail. So essentially, if we take, in fact, I'll give you a sort of illustrated example. I've got at the moment a manor house. The scheme I'm dealing with is circa 300 meters away. It's a significant scheme. The manor house is within quite an idyllic set. It's and also you've got to remember that is quite a limited market that's looking at those properties. So having an infrastructure scheme 300 meters away from something that is quite secluded and isolated is it's likely to have a depreciating effect on that property. So what we're doing at the minute is looking at the loss to the that have incurred because of the scheme. We've basically taken a slither for the scheme as part of on the estate, and now we're looking at the loss to the land and property as a result of that scheme being in place. And that's involving looking at the environmental statement, market evidence, speaking with local agents, speaking with country house experts to try and get a clear idea of what that impact is to the retained land. And one thing we're having to look at is what the impact is on the works and the construction, because there's quite a significant amount of works that take place, and the subsequent use of the work. So that when that scheme's in place, what impact is that going to have on the property? And the methodology used to deal with that is a before and after valuation. It tends to be, that's the way we look at it. What was the value before? What is it after? Now we've got the scheme in place. And I've put that case there, Abbey Homesteads Group Limited. That case focuses on separating out market value, the cost of land taken, and the injurious affection and severance to a property, and looking at them very separately to market value. And that's something that the case I've got at the minute I'm dealing with, I'm having to do. It's doing a before and after valuation, and it's about looking at the impact to that property with the scheme in place and the works going ahead. And the way I'm doing that is looking at the environmental statement that's applied. I'm as I said, talking to the agents. I'm looking at comparable market evidence. There is a hierarchy of evidence that we as valuers use, and that is the key evidence. There is market evidence, not always available. And a key point to reflect is the valuation date as well. So the valuation date for this is January 2021, the one on my case. And it's really difficult to kind of put yourself back in time. At the time when we took that land, what could you foresee as injurious affection going forwards. And one thing we are concluding in that case is that the threat of the works and the construction would deter a potential purchaser away, and the level of the loss, essentially the injurious affection, comes more from dealing with the works than it does the subsequent use of the works, because actually when we reviewed the environmental statement and other bits, there's not a lot of noise that's created as a result of the scheme. It's more about what works is going ahead for a period of 3 to 4 years around that property, and what at the valuation date, what loss would that have created? And that is basically the injurious affection element. Another sort of one would be I dealt with a commercial property in the Midlands, and we took half of their car parking, and the type of business that they requires them to have people leaving and going throughout the day. And they owned this particular property that didn't lease it, and we were looking at a loss in value as a result of taking that those operational car parking spaces away, and also led to, which I'll talk about further, some disturbance losses from a loss of profits, but I'll talk about that separately. So next slide, please. So severance now, and that's found within Section 7 of the Compulsory Purchase Act 1965. But if you go to the next slide. Okay, so severance throughout the compensation code, severance and injurious affection can be talked about in the same context, but actually they're very different, and the way we look at it has to be treated differently. And as per the case that I've just mentioned on my previous slide, that case basically said that they do need to be talked about separately because they are two separate concepts. And essentially severance, and quite rightly, because I agree with this, is the division. The Housing and Planning Act 2016 drops the terminology of severance to division, which I think is so much better than severance, to be frank with you. But essentially it's the loss in value to the division of land. And I've only ever dealt with severance on farm rural properties when dealing with the issue around farming post a scheme. And it is essentially looking at what the impact's been to the farm as a result of severing these two parcels from each other. And that essentially is the loss in value as a result of that. There is options within the code to have the acquiring authority purchase the remained area of land, particularly if it's not capable of farming. It's less likely to be done these days because there tends to be, especially with farming diversifying, but essentially it's the loss in value and as a result of the dividing a property. I have had one residential property where we divided some paddocks from the house, and they argued that now because the paddocks are separated by a road, that has created some loss in value to the property, and that was upheld. So there is a number of examples behind this, but I mainly, and so does the code, I mainly have only dealt with that on farmland. Okay, next slide please. So disturbance compensation. So next slide please. Disturbance is probably the one that holds up claims being completely settled on a full and final basis. It's usually the bit where it does require quite a bit of negotiation, interpretation, and it's any losses that are separate to the Rule 2, the market value. It's found within Rule 6 of Section 5 of the Land Compensation Act, but the key fundamental principles that were founded in Harvey and Crawley, and the Director and Buildings is a much more recent case. They tend to be the tests found within those two cases tend to be the key area of governance around assessing disturbance. And the three tests are: if there's a causal connection between that loss, losses must not be too remote. So not claiming for something random. That I had one where there was a removal cost, and they claimed that they needed a brand new outdoor area because they essentially had that in the previous property, but which they didn't, and it was put on the claim, and that was again too remote. And duty to mitigate, they need to show that they've mitigated their losses, and that's usually done by gathering a cluster of quotes linked to that loss to show that they're picking and they're looking and they're mitigating their losses, so they're getting value for money. And those tests they tend to be that they are the 3 tests that we look at. I'm dealing with one at the minute at the same industrial site actually in Birmingham, where I'm looking at the removal costs and whether they're reasonable or not, and whether they claim it actually mitigated their losses. We're arguing he didn't, and because we only had one quote and he just went and did the removal on his own and didn't work with us on that, and he has sent through quite a number of costs that just are completely are so far beyond what is deemed reasonable that we're arguing that he hasn't mitigated, and it's a real tough negotiation to go through, and it is requiring us to go out and get our own quotes, because that's not been carried out with the claimant, to prove that those costs are just not reasonable and the claimant hasn't mitigated his loss. Okay, next slide, please. So statutory loss payments. Next slide, please. These are additional compensation sums that fall within the heads of claim. They are designed to deal with the impact of having a compulsory acquisition. They tend to be misinterpreted, but essentially they're governed by statute. There are set levels. Those levels are found within those sections that I've described there. So you've got them in the section 33A to F of the Land Compensation Act, because that was originally where they were placed. They've now been sort of amended and put together, particularly the home loss payments in the 2004 Act. You've got section 29 of the Land Compensation Act as well, and then the home loss payments prescribed amounts, which sets out the key levels in which they are to be paid. So next slide, please. And these, I've put the levels on here. They don't tend to be argued because they're set in statute. So you don't, essentially this is particularly if you're dealing with a professional representative, they are put down, they're set. The only time you do tend to get a bit of misinterpretation is if you're dealing with basic loss and occupier loss, particularly if it's not owner occupied. And then a 10% amount is put on rather than the 7.5%, which if they're not occupied would be 7.5, but if they were owner occupied for non-residential, it would be the 10%. And those caps and levels are set there, but these are never really. I don't get any argument really on these points, because you can't. They're set, and it's not a negotiation. They are set amounts, but from a cost perspective, this has to be included in a property cost estimate. They are. If we are acquiring the land by compulsion, they are payable. If we are acquiring land under the threat of compulsion but not quite there, and you want to get an agreement, they do tend to be paid, because it's an incentive to get the land early, and also it's showing that we are willing to work with the claimant earlier rather than later. And as Becky's already discussed, CPO is a method of last resort, and we want to work with landowners most of the time, and that's what all the up-to-date legislation and the Compulsory Purchase Association focus on these days, is trying to work with the claimants and improving that claimant experience. So these do tend to be paid on top of the heads of claim, even if it's not by compulsory acquisition, particularly if we want the land early. Okay, next slide, please. So that's me done. Thank you. Over to Claire.
So back to me for a few minutes while the other ladies get a drink. Thank you, Becky. Thank you, Selina. So it's just a very quick overview from me on some of the changes that have come up in the Levelling Up and Regeneration Act. What I would say is I don't have a great deal of time to go through it in detail today, but there is some further training that's now being given by Andy Ward in particular at DLUC, who is the policy lead. We at Homes England are actually hosting a session next week, which will be, it's going to be quite dry. You know, I'm going to be honest, it's just going to be very going through the act, very legislative. But if anybody is interested in attending that, please just drop me an email and I will get you on board. Andy is then the following day giving the same presentation to the Compulsory Purchase Association. So if you are a member of that, you might choose to dial into that one as well. But essentially, the main changes around valuation, I'm not going to go through all of the other changes because we are focusing on valuation today. It's really around the hope value question. So I'm sure that all of the CPO practitioners in the room will already be aware that essentially at the moment, the compensation is based on market value. And there is the principle of equivalence in the before and after. And market value as it stands at the moment also has to be considered in what we call the no scheme world. So essentially the impact of the scheme has to be ignored when you are essentially coming up with a market value that you are going to compensate the person who has had some of their land interest or property acquired. There are, however, in the LURA, certain changes under Section 190, and they are actually going to be switched on at the end of January, as I understand it. That will then be subject to a few months' consultation, and Andy is writing the regulations as we speak. So I'm not going to go into the regulations and things at the moment because I don't know what they are yet. But essentially, new powers are being granted to certain types of development whereby hope value, so essentially what you would say is market value is the land value plus hope for development. And that is kind of what you would assess to be the existing use value. So you have your agricultural land, you then have your hope value because you think it's going to become residential development land, as an example. And it's that gap in the middle that we call hope value. So it's the hope of something else happening. And the LURA proposes that for certain bodies, and I'm going to go through which these bodies are in the moment, and for certain types of development, hope value can essentially be disregarded and essentially compensation will be pegged more to the existing use value. So essentially the bodies that will be able to ask for these directions, and you will have to seek directions to pay at EUV. It's going to be local authorities, so lots of you people that are dialed in today, other certain acquiring authorities, including Homes England, NHS bodies and development corporations. They will be able to seek directions from the Secretary of State, so they will actively have to seek these directions, and they will only be for the purposes of development of housing development or development that has to include affordable housing, health and education schemes as well. So in terms of applying for the directions, obviously evidence will have to be provided as to why the Secretary of State should grant the direction. So viability evidence will have to be provided that the Secretary of State will go through before granting the directions on top of the order. And don't forget that the direction request has to be on top of all of the other usual hurdles that would need to be met for a CPO. So you still have to prove that the scheme is in the public interest, that it's deliverable, that it's viable, that you've taken account of equality impacts and any other impacts on the acquired property. So it's something that's new. It's breaking news in terms of the LURA. I'm not going to say too much more about that now because we don't have time and you really do need to look at it in a lot more detail. So I do suggest further training on that matter. But as I say, I'm running a little session on it next week with Andy from DLUC. CPA are running a session. So if you are interested in finding out more, please contact me and we'll get you logged in for one of those. So next slide, please. So I think we're pretty much on time. In fact, I'm a minute early. I do apologise for that. So Q&A. So Becky, Selina, hopefully you've had time to wet your whistle with a drink and you're ready to start answering the questions. So the first question was actually one that we had that was submitted prior to the session, and it's around the level of contingency. So when we're coming up with our property cost estimates, and as you say, you put a contingency in, the question always is, what sort of contingency should you be putting in? What sort of percentage? What are your thoughts on that, ladies?
Do you want me to start?
Yeah, go on.
Usually at the start of a scheme, I go 20% is essentially the rule of thumb. But as things get more certain, negotiations get more in depth, and we get closer to settlements, that reduces down. And this is why it's so important to have those 6-month PCEs to try and eliminate that risk, because that's essentially what the contingency is doing. So over to you, Becky.
Anything to add on that?
Yeah, no, I mean, I would say exactly the same. Start at what your project thinks is appropriate, but 20% is a very good starting point. It is one that I commonly used. There's one I'm working on now where we have reduced the contingency just because we have so much more knowledge. I think we're down now to around 15%. You might find if you've made a significant number of acquisitions and you've got a really good tone set in your area, that you might be able to reduce it further. But as Selina says, it's the more knowledge you have, as with any type of project, the more knowledge you have, the more certainty you have, the more you can reduce your contingency.
I think one of the key takeaways from the sessions is actually this thing called the property cost estimate, and you have to view it as a living, breathing beast, and you have to keep going back every time you have more information on a lease, or if there's a significant market change, or if the level of statutory loss payments changes. You have to keep revisiting the PCE, and you can start with a really rough one, in the early days, just almost back of a cigarette packet, but the further you refine it, and in terms of local government and central government as well, applying for funding to programs to acquire land and pay these kind of things, it really helps with your BCRs, it helps with your business case to Treasury, it helps asking cabinet, but they are going to ask how much certainty is around this property cost estimate. So I can't impress enough, get in early, get a PCE up and running, and don't just file it in your CPO file somewhere. Keep going back to it. And I mean, I know you say 6 months, Selina, but as often as you need to, as soon as you change.
Definitely. Yeah. The one that I actually referred to earlier, where we review on a 6-monthly basis, which is good practice, there have been occasions where we've reviewed more regularly, where something more substantial has changed. If the smaller the change, that you might just record it and live with your existing PCE, but if something really substantial changes, update your PCE.
Absolutely.
Okay, so another question that we've had, and I will give the usual weasel words in front of that, we can't give specific tax advice to individual claimants, positions, etc. But is it tax advantageous, somebody's asked, to wait for the GVD, or sorry, the general vesting declaration? So is it better to wait for somebody to CPO land rather than actually try and do it by negotiation up front? Is there a tax advantage to waiting?
Well, it depends on the time. I know there is times when I've had where I'm doing things by agreement, and they'd rather me do it after April as opposed to in the financial year, because they're worried about that hitting them in terms of tax. I guess it depends on the type of business or property, and it depends whether the land's opted for tax as well. So there's a VAT issue there. But if we're doing things by agreement or via GVD, they'd be dealt with in the same way. SDLT, if we look at that's payable under as a separate item, and essentially you would pay that if you were doing it by agreement. Or through under compulsion. So I guess it's more to do with if it's whether they've opted for tax, but again, you would deal with that in the same way. So
I think from a local authority perspective, it's important to have in mind the impact on your your VAT status if you're making
Absolutely.
really significant acquisitions,
Yeah.
and just keep your tax advisors informed as to what you're doing, and seek their advice at the appropriate time, early as possible, because they have a tendency to shout if you if you don't get them involved early. But keep them in the loop, because there are VAT implications. But I think it's almost a case by case basis.
It is, and I was going to say this is actually one of those reasons why it really pays to have professional advisors, hopefully advising the claimants, because everybody's circumstances are different. And, you know, somebody's mentioned capital gains there. People have different rollover reliefs. It depends on the type of land that's being acquired. But actually, if you've got a professional advisor working with you, then they will be able to work with the authority to hopefully ameliorate the tax position for the individual being acquired. And actually, that's something else that came up with the questions about betterments. And we haven't really mentioned betterments and accommodation work. So I think
I've got a big one for that in a minute.
Yeah, I mean, something that actually in the PC usually is if you are able to, well, people are going to lose their land, so they're not going to be happy, but sometimes you can actually maybe put in fencing or other routes to the land or bridges for livestock that make it not as bad. I mean, don't get me wrong, it's bad that your land's being taken, but it's not as bad. And
so
those are accommodation works which should be reflected in the PCE, but
absolutely.
also then going forward in terms of the negotiation of the compensation, there is an element then potentially of betterment, which can also work in the acquiring authority's interest to offset the amount of compensation that's made. Ladies, any case studies or examples on that?
I've got a big one. I've got a big one on betterment at the minute that I have actually. I'm just had it. Casey advice, who has backed my opinion, which is good. So essentially we've got a road scheme going through an area of land that's opening up a wider area of housing development, and what we've had, and I'm arguing that infrastructure is required to get the volume of housing within that area approved. Essentially we have 2 floating planning permissions going in. And the policy, the actual planning policy, includes the road scheme within that as well, so that kind of backs it up. But what I have had is some quite high profile developers, which Homes England will be used to dealing with, arguing that that they would have been able to deliver the level of housing without that infrastructure being put in place by the local authority. And so I've been in the last 6 months pulling together a betterment case and arguing that we should be paying nothing for the land from these developers, because we are essentially inflating their land to such a level that pre-scheme, in a no scheme world, the right terminology that we should be saying, that they would have had an element of development, but not to the scale that they will have post scheme. And therefore I'm not paying any compensation for land taken as a result of that scheme being put in place. And I've pulled together this case and sent it through, and had some KC advice just come back actually who support my opinion. But it has been a bit of a journey getting there. Betterment is a really difficult subject to overcome, and it's been debated throughout case law and within the compensation code for many years. But this one is the best case I've ever had as a professional that clearly shows there's a level of betterment. On other cases where I've had that, I've paid existing use value, if I'm truly honest, and not looked at that long-term development, but just to try and get a negotiation through. But this time I'm 100% sure that there's clear betterment, and that's what we've put forward to those developers, and we're getting somewhere. But I think I've got a bit of a journey, and there's been a lot of technical input had to be put together for that. Accommodation works, which is a bit of a different one. I've got a case study that I dealt with a development site in Coventry as part of another road scheme. Actually, the scheme was actually basically the scheme design included a hammerhead from this particular site where we were taking some land, which limited the long-term access for this site, and it had planning for an Aldi supermarket. And with sort of negotiation with the design team and others, we accommodated an access road, and actually we ended up paying nothing in compensation because we applied this access road which allowed that Aldi to still be implemented. And some people on the call might know exactly the Aldi we're dealing with, but we ended up mitigating and not having to pay significant amounts of injurious affection because we'd accommodated this site for long-term use. So it was a really good win for National Highways.
So some of the other questions are quite specific in terms of around who has qualifying interests. I don't think we've got time to go into that today. There was a question about CPO powers for RPs. What I would say is that, you know, essentially various acquiring authorities will have their own powers. So again, without knowing the actual status of, you know, the RP or whether they're part of a wider agency or whatever, I can't really answer that question. RPs themselves, if they are limited companies or charities, are unlikely to have their own CPO powers. CPO powers tend to be granted to acquiring authorities like local authorities, government agencies, or, you know, people like Highways England for specific infrastructure schemes. So it's unlikely that they would have their own powers. What I would say within Homes England, though, obviously, is that we do a lot of work with registered providers. And it might be that we would be able to do a scheme alongside an RP, but I'm not going to go into that for too much detail now.
There is development consent orders now as well, so that which tend to be sort of privately led, private developer led, but that has to be a significant infrastructure project. So which is but
I was going to say some of the other questions coming around ransom strips. There are so many questions. I'm almost wondering whether we should be suggesting to the LGCC team that we actually do a specific session on ransom strips. So if that is of interest, people do please let them know. So any comments, generally speaking, on how CPO can be used if there is a problem like a ransom strip that crops up in your scheme? Becky, have you had any experience of that?
I'm trying to think, not specifically on anything recent, in that there've been quite large CPOs wrapping up everything. So I actually, sorry, no, I don't have a very
if you don't, that's fine. How about
I can think of some back in the dim and distant past, but I'm going to have to dredge my memory for example. So if Selina's got something more current, that would be.
Yes, I have. And the rule of thumb from a valuation perspective is to look at how that is impacting the wider site and the level of that. If you look at it as the typical Stokes in Cambridge type way, and the example I've got at the minute is the scheme has taken some land off a developer, which provides access to a wider development that's not owned by the existing developer. So which would put the developer one, who we've acquired the land from, in a ransom situation. They've got a ransom strip essentially, and we are looking at that in how that what that provides for that external development site. There are two accesses potentially, but this is one. So for the purpose of a PCE, I've actually applied 30% to the value of that when compared to the development site too. If it was the only site, I'd be looking at 50 in accordance with the Stokes principle. And you do follow that principle, and in negotiations that tends to be the ground point for ransom strips, to be fair. It's dated, but it works.
It is. And I think it's such an error in itself. I think that, let's say, ransom strips might be a specific section on its own.
Yeah, it's a complex area.
We are starting to run out of time. So one question which I thought was quite interesting is essentially, if you have, I wouldn't say necessarily an illegal use by a property owner, but if somebody has let a building fall into disrepair themselves and they haven't done anything, are they entitled to any CPO compensation?
So if their property is in disrepair,
if it's their own fault that there's a delapsed building, I mean, there are obviously rules around if a property or something has been used for illegal practices, then definitely no, they're not entitled to CPO compensation. And I think there are other rules as well around it. It comes back also to which powers are used. So listed building CPO
so
powers.
I've got one at the minute on listed building, actually.
Oh, go through with that, Selina.
So I've got a large house in Buckinghamshire that Buckinghamshire have actually instructed me recently to deal with. It's actually gone into a major disrepair, and they're in breach of their listed building consent. And Buckinghamshire are looking to acquire that by compulsion back to try in order to put it back into an element, well, in accordance with their listed building consent. The problem we've got is we can't get hold of the blooming claimant at the minute, so it is going through quite formal CPO process. But yeah, that's a key example of that. If the property's in disrepair and you're acquiring that property, then you're valuing it in disrepair.
Absolutely.
Essentially. So you're not going to be making that look better than what it is. It's what it is, essentially.
And I would say as well that, if notices are being served like urgent works notices or repair notices, that essentially you would be offsetting the cost of those anyway from the compensation, because they would essentially be a charge on the title. So, you can CPO single buildings in disrepair like that, but you would then, any compensation due to the landowner, you would be looking probably at very, very little, because of the condition of the building is probably means it's a liability more than actually worth anything.
Yeah,
Becky, you were going to add something there.
Yeah, it was kind of that point about offsetting. So, for example, if there's outstanding rent and you're addressing or other outstanding bills and things like that you might be able to offset against compensation, there are a whole range of different things that you might offset against the compensation. If there, so you only pay them, I suppose what it's worth, and if there's costs against that, you offset those. There's a few examples I've worked on where we've had where it's actually been the acquisition of leasehold interests where there is outstanding rent, and so that's obviously been offset against the compensation. It's similar point.
Principle of equivalence again.
Yeah,
so
it is. And I think the final question before I sort of move into the wrap up slides. So, injurious affection if there is no land take.
Yes. So yes, but they'd have to be one, you've got the part 1 land compensation.
I was going to say part 1, yeah.
So that is where no land's taken, and both me and Claire have done a load of these back in the day.
I've still got the scars, yeah.
But yeah, so that is essentially down to environmental factors. There's 7 environmental factors impacts the property that you assess, and that's where no land is taken. It has to be. It tends to be with residential property, can be with commercial, but it's that small business rate cap on that one. And then you can have injurious affection for properties where no land is taken, but there has to be a physical injury to that land, and it has to be solely from the works and not the subsequent use. An example of that would be, I had on a highway scheme a few years ago, was a petrol station where we'd taken away their access, and it was the injurious affection as a result of that. And it's found within section 10 Land Compensation Act, and it is what's known as the McCarthy rules. There's 4 rules that have to be complied, but it focuses around a physical injury to land and just solely the actual works and not the subsequent use.
I would say section 10s are quite rare. I don't think I actually dealt with any.
I hate dealing with them. I've dealt with 2 and it's horrific.
And part 1 claims, you will get a lot of part 1 claims that put in, but not very many will actually be successful.
Positive, yeah.
So acquiring authorities take heart in that. I think we'll just end up with the final question around regeneration zone and master plans. Does that potential value uplift get taken into account? Well, it depends on kind of where the scheme is and when these zones are basically declared. You can't get away from the fact, if you are acquiring some land that is allocated for development, hope value to some intents and purposes has been crystallised. And so you cannot look to try and get away from paying what will be that market value or the EUV plus the hope value. But it's all a negotiation, and this is again why with very good advisors you would look to minimise potentially what the impact of that would be. But it's only fair that people are treated with the principle of equivalence, because
Absolutely.
it's not a nice thing for people to have their property or land taken. So thank you, Selina and Becky. I'm going to ask for you to disappear off on camera now. I shall do the final wrap up. Thank you, ladies. So next slide, please. So top take-home messages for you before you all get off for your sandwiches and jacket potatoes. Top 5 tips: do check your internal governance procedures and be prepared in terms of how often you're going to have to go back and beg for more money if your PCE goes up, for example. Make sure that the right professional advice is always sought. It's a tricky area, as you can see from some of the case studies and discussion in the Q&A today. Make sure that you've got the right legal, surveying and other advice. Keep reviewing your PCEs, as I've always stressed. Speak to other people doing this kind of work. There's nothing like experience sharing and just comparing the wounds of the brutality of the process as well to make you feel better about life. But don't be afraid. There are successful CPOs every year. There are regeneration schemes coming forward that are absolutely flying on the back of CPOs. Nobody wants to do it, but unfortunately, sometimes belt and braces, it's something that we do have to do. So don't be afraid, but make sure you go into it with your eyes wide open, as it were. Couple of key organisations. The RICS will be able to point you in the direction of qualified surveying professionals, and also the Compulsory Purchase Association are there with a raft of information and training for people as well. And also the Levelling Up and Regeneration Act, the CPO clauses can be found in the link there that will be shared with you afterwards. And there is some really, really good guidance that you can give to affected parties that you might be dealing with on the gov.uk website. Next slide, please. So I think we're actually 3 minutes early, but I think we'll wrap it up there. So thank you all for your time today, and I might see you again at some point. Thanks very much, everyone.